Good morning. It is just gone 11 o'clock and that's probably a good time to kick off today's webinar, Cash Flow Management. Now, firstly, welcome to all those who have joined me this morning. We're going to go through some basics for the next sort of 45 minutes or so on what's involved, not just in managing your cash flow, but in maximising it. It's one thing to have a handle on where things are at and to think you've got it under control. It's another to actually have a look at your trends and what's happened in the past and what you can do in the future to make sure that you maximise your efforts, because we all know it's hard enough in business as it is right now. There is no sense in leaving cash on somebody else's table when it should be in your bank account, working for you, doing what it does best. So we're just going to roll through this for the next 45, bit of a Q&A at the end if you like, and we'll go from there. Now, there's 7 key drivers of the cash flow. Some of them are on the balance sheet, some are in your P&L effectively. Some of them are, they are in effect your assets and your liabilities of your business and what you do with them. Now, we'll go through each of those in detail. We'll give you some exercises where you can actually go back to your business and sit down with your numbers and have a look at what you've done in the past, where you're at now, and maybe come up with some strategies in terms of what you can do in the future. And my contact details are there. There are a ton of other ASBAS advisors around who can sit down with you and go through where you're at and what we can do to make it better. Okay. Now, like I said, in the balance sheet, and none of this is rocket science, by the way. There's nothing new here. I haven't invented anything. These are all the fundamentals of business, right? Your accounts receivable, your accounts payable, and your stock or your work in progress. They're the 3 big ones on your balance sheet that drive your cash flow. In terms of profit and loss, you've got your day-to-day activities, you've got your pricing, you've got your sales volume, you've got and then cost control, cost of goods sold, and your operating expenses or your overheads. Those 4 things are the big ones that make sure that you maximise the cash coming out of your efforts and your team's efforts. Now, we'll run through those individually, and once we've done that, we will then come back and have a look at where you're at. So accounts receivable. Now, these slides might be a little bit wordy, but that's okay. That's so you don't have to take a ton of notes. All right, it's all written down there for you. The recording will be available later. You can run through these at your leisure. But management of your accounts receivable is one of the key things you need to do. Okay, it's simply a case of how long does it take people to pay you. Now, if you're operating in a cash business or you're getting the bulk of your money up front, that's brilliant. But most of us don't. Most of us are running a ledger where we've got people who owe us money. We tend to run on terms of 30 days, although some people are 14, some people are 60. It depends on your clients and your terms of trade. And we'll get to that in a second as well. But primarily we're running on 30 days. Now, do people pay you in 30 days, or do they decide to pay you in 45 or 60 or 90, or whenever you ring up and harass them, they're really just paying the squeakiest wheel? That's something that you need to look at over time. Okay, you can do the numbers right now and you can say, okay, my accounts receivable days are 60. And if your terms of trade are net 30 days, 60 is not really flash. But if you look at the trend over time and you've come from 90 back down to 60, then what you're doing is working, keep doing it. If your days have snuck out from sort of 48, 49 out to 60, which you probably would have noticed, but in the heat of business, sometimes the little things just get past us for a month or 2 or 3. They're starting to sneak out. You want to step on that fairly quickly. Okay. Now, the way you work that out is there in front of you. It's a very simple ratio. Right? All of these are simple. If they weren't simple, I couldn't work them out. Okay. So they're nice and easy to have a look at where you're at and what you're doing. Now, you can run the numbers on your own business, but if you like, at the end of the presentation, when you roll through it, there are actually some financials from a client of mine who very generously agreed to share them, provided I deleted anything identifying. And they're real life figures from a trading business that actually generates a fair bit of cash. And you can have a look at how those trends have fluctuated over time, how those numbers are changing, and get a feel for where they're at and what they've done. Okay. Now, here's one of the other keys with this ratio. If you're running on an overdraft or you're using debt of finance or some sort of factoring, when you work it out, this trend will show you how many days interest every sale costs you. Okay, because this is your average. So you're collecting at 60 days. So on average, every sale costs you 60 days interest. Now, of course, on the other side, if you're paying your debtors slowly, then you're saving interest. So there'll be a net effect in there. But if you can reduce your accounts receivable days, just not through being, running out breaking legs or anything, but just sound management, just keeping that relationship with your clients strong and getting them to pay a little bit earlier. Not only are you getting the money earlier into the business so you can use it, but you're also reducing the cost of that money. And that's one thing we'll also touch on again later in the presentation. And that's what it comes down to, is about control and maximising your efforts. Now, there's two things you need to remember. One is you've got to have a solid credit policy, and that credit policy has to be explained to your customers, is that it's 30 days net and that's it. And if we go over that, then we start looking at letters of demand. Okay, and you need to be efficient about it. There's been a collection process there that is systemised and is efficient. So it's not a case of, oh, look, I just might ring some people up or get the office girl to chase some people up. And it must be something along the lines of Thursday is collection day, and that's everybody who is over 45 days. Whether they're 46 days or 60 days makes no difference. You draw a line, and that's how you play. Now, we all know that in times, not everybody can pay on time. That's the nature of business. And at times, they have this quite reasonable explanation for why they can't pay now. And at other times, you're sitting there thinking, yeah, they're spinning me out. They're just taking advantage of what we're doing here. So that's where your policy needs to be firm in terms of, this is how we play. You may want to make the odd exception for good clients, but if they're not paying you on time consistently, are they really a good client? Are you increasing the margin to allow for the cost of that? Because fundamentally, guys, as I say down the bottom there, you're not a bank. Okay, so stop acting like one. Okay, it's your money that they've got. Set the lines, stay firm, and improve your cash flow. Because at the end of the day, it's your business. It's your money. They owe it to you. And there we go. Now, this slides, just while we're going through it, is actually a workbook that I use for a 2-hour workshop. So we're going to take 2 hours of interactive playing with numbers, which may or may not be your thing. We're going to squish it in around about 45 minutes of me just talking at you and giving you some stuff that you can go away and do later. Okay, so we're not sitting here for 5 minutes looking at a blank screen wondering what everybody's doing with their numbers. Accounts payable. This is the other side of that, where it's the money that you're paying out, obviously, for the stock and the bits and pieces that you've had come in, supplies. It's essentially the same equation to work out where your accounts payable at. And this is something that a lot of people don't get too stressed about. They don't really worry until somebody's ringing up, because they're not quite understanding this is the reverse of the other situation. The trick with accounts payable is don't pay early. Unless someone's going to give you a solid discount for paying early, don't do it. One sec. Sorry about that. Don't pay early, okay? It's simply a case of pay when you have to, whether that's paying on the 30 days or they cut off supply, or if it's simply a case of paying at about 45 odd days, or paying when they ring up and they'll keep supplying you. Pay when you have to, because the more money you've got in your bank account, the more things you can do with it, like pay wages, get in stock on special, all these little things that make more money for you. It's your money. Don't forget that. Now, this is the risk, of course, of taking that strategy of just stringing it out until you absolutely have to, is that you could end up with supply problems. And again, I'm not reinventing the wheel here. We all know this, that sooner or later, if you keep stringing people out, they'll stop delivering and you'll go to COD. And if they've got something exclusive or something that is key to your business, you've got a problem. So you need to monitor your performance here. Again, a simple thing, just have a look at your ratios and have a look at, print up an aged debtors and creditors listing every month. If you're not already doing that, you really should do that. And just highlight the people who are way out there in terms of both creditors and suppliers, and make sure those relationships are solid. Because if you've got creditors who are consistently if you've got debtors who are consistently well out there, all right, are they really good customers? If you've got creditors, people you owe money to, who are consistently out on the edge, how much longer can you maintain that relationship? And is it really good business to have those numbers sitting out there? Now, the other thing, when you're running these numbers over time, as I say at the bottom there, look at the trend. If those numbers are trending down, so you're actually paying earlier and earlier, now that's reducing your cash reserves. There may very well be a reason for that. You need to think about what you're doing there. because you want to try and balance that out between keeping supply and maximising the cash you've got to operate with. Right? Rule number one, never pay sooner than you have to, noting that the people who owe you money are doing exactly the same thing. So you've got to balance it out. And again, play with the numbers at the back, run the ratios on them, see how they pan out, and get a feel for how those guys run their business. Now, stock and work in progress. Now, this is always an interesting one. I'll just start. This is a bit of a story here for everybody. When I finished high school and sort of had what is now called a gap year, I was working in a spare parts shop, and we fixed cars. We had a wrecking yard and all sorts of stuff. But right down the back in the mezzanine of the workshop was what we called the mortuary, where we kept all our dead stock. And this was parts for Renaults and Peugeots that were no longer made, parts you could no longer import because the guys who were making them got out of business, just really rare and old stuff that you sold 3 things a year out of it. Now, that money had actually been written off the balance sheet. That stock had been written off the balance sheet. They'd taken a hit on the P&L for it and put it down there. So 2 things. One, there was actually a fair bit of money sitting on the shelf. Even back then, with stuff that had been bought years before I turned up, still a lot of money sitting on the shelf. And 2, we got that out the door whenever we could, because that was money back in the business, obviously, and it was pure profit because we'd already taken the hit earlier on the P&L. And the reason that the bit I'm getting to is that the first line there, the efficient management of stock. A lot of that stock was there because the guys who owned the business didn't manage their stock efficiently. They weren't paying attention to which models were coming in and out of production, and they ended up holding too much stock for models that were just being run out and not sold. And that ended up with them having a lot of money tied up in dusty stuff way down the back upstairs. Not necessarily very efficient. Now, just to come back to the slide now, if you're having a look at what you've got in the way of stock or your work in progress, it's a simple calculation in terms of figuring out how many days your stock sits around for. Now, again, that's the formula I've got there is for an annual figure, but it's really just a case of if you want to track it over time, just replace the 365 with whatever time period you're using. Downward trends means that your stock levels obviously are falling over time. Okay, or your cost of goods sold is fluctuating a bit. We'll get to that again later. And there's 2 things to focus on there. One is that may be very efficient management, or you're doing very well, which would be great, because what you're doing then is you're minimising the amount of money tied up. You're working more on a just-in-time inventory process, or your work in progress processes are getting much more efficient, and that maximises your cash flow. The trick or the catch is that if they get too low, then you might not be able to supply orders, which may end up losing your business, and that's not real flash when it comes to cash flow. So again, it's a balancing act, but in general, have a look at your stock days, because you don't want that to be creeping out too far, because that's simply money that is not working for you. It's just sitting there doing nothing. Okay. Now, the other thing, as we just said, it's if the number's spitting out, you could be very, very well building up a lot of stock that is simply tying up cash. Now, here's the thing too. If you're a service business, all right, work in progress. Now, for manufacturing, it's very easy. You've got to factor in work in progress. You've got to take into account the wages, the materials. If you've got a very tricky accounting system, you can throw in usage of power or machinery cost. But again, it's all about keeping that cost under control so that you're maximising your cash flow. Service business, it's your labour cost. Now, I know a lot of smaller service businesses don't really focus on this because they just figure the job needs to get done. They do what they have to do and they get the money in. But if you've got a lot of people, a lot of hours tied up in low margin jobs where you could have reallocated them into a higher margin job, then clearly that's inefficient. So you need to do one of 2 things. You either need to get them doing the lower margin jobs quicker, or get more staff, one of 3 things, get more staff on to do these higher margin jobs, or replace the staff who are inefficient, which is an entirely different webinar altogether. We are not going anywhere near that today, I can assure you. Okay, but it's the same thing. It's the same impact on working capital. You've got to pay wages, you've got to pay the power bills, you've got to pay rent, or you've got occupancy costs. All these things factor into your cash flow. They all impact your cash flow. So have a look at how much time you've got tied up in your work in progress, in your stock levels, and in what's really happening in your business. So again, let's roll down. I'll tell you what I will do is we'll have to go down here for a second. I'm going to skip well ahead here. Here we go. And these are the numbers I'm talking about. All right, a little bit of a cheat. As you can see, there's a lot of fluctuations in these numbers over time. So, all of those fluctuations, when you have a look at the fact that there are also fluctuations on the liability side, okay, and then you have a look at the fact that the sales figures are constantly increasing, those ratios will fluctuate a fair bit. Now, some of that is due to some very tricky R&D write-offs and some accelerated depreciation, and that has an impact very much on the net profit, because even though they're showing a loss here in 2017, the actual earnings before interest, tax and this is actually a net cash figure, right? They're actually cash positive $400,000. That's what I was saying right at the beginning. Have a look at the figures. These guys generate some solid cash. Well, there's some good money in that, and they manage it very well. So run those numbers, as I say. Oh, here we go. Run through these with those ratios and just see what sort of numbers you come up with, and then have a look at your numbers and see how they compare. This, by the way, is a manufacturing business by and large. They do some export, but they really are only exporting what they manufacture. So they'll give you an idea of work in progress, okay, which is included here in their stock figures. They build it into that. Okay, so that's what we're talking about. We're talking about, have a look at the numbers. That's where they are. That's what they look like. So back to stock days. Now, here we go. Now we're into the profit and loss statement. The P&L is always fun. Now, price change refers to how much can you move your actual sales price without really killing yourself in the market. Now, there are things that are almost impossible to predict, okay? You can have price rises in your cost of goods sold. You can have fuel prices go up. You can have, you'll probably unlikely to have a wage rise go through of any great significance recently. But you need to be able to accommodate these fluctuations, okay? You need to be able to have some elasticity or some fat in your cash flow so that it doesn't cause you massive dramas. Now, in terms of those, you need to know how much room you've got to move in your margins if you want to actually keep your cash levels consistently, cash flow levels consistent. So in that regard, there's two things you can do. You can go down the commoditizing route where it's very competitive. Everybody seems to be competing on price, so you go and compete on price. Word of caution, okay, a word to the wise, is that you know and I know that if you're going to compete on price, okay, that's going to hit your margins unless you can then turn around and have a look at your cost base, which we'll get to in a minute. But if you're going to start discounting, okay, as in 20% off this, 30% off that, constantly having sales all the time, what you're going to do is you're actually going to start training your customers to expect that discount all the time. I would suggest that bundling is a better way to go. And again, this is just simple, common business practice. A great exponent of bundling, which we see every day when you go shopping, will be Mathers, the shoe shop. Right? Second pair half price, on the lower priced of the two. You pay full price for one pair, grab another pair, whichever the cheaper one, bang, they'll knock 50% off. That is a very good way of playing with your margins and building your cash flow, because you're getting obviously one thing out the door at full price and you're only giving a discount on the cheaper of the two. Now, allowing for the fact that you've still got some margin in there anyway, you can probably just squeak away with that. obviously set that second bundle, or the bundle discount. You're obviously going to set that within margin. You're not going to give it away at a loss because that's pointless. If you're going to do that, you may as well just basically sell the first item slightly less. It'll have the same impact on your cash flow. But if you do your bundling right, it's a nice boost to cash flow, keeps the money coming through the door. It will reduce your margin, that's obvious, but it boosts the cash flow, and it's all about the cash because cash is king. Now, if you have a look at McDonald's, when they do a price increase, they sneak it up. It's 15 cents here, it's 10 cents there, it's 40 cents there. Nobody really notices in the overall scheme of things. And that's one very, very smart way of doing it. If you're looking at adjusting your margins to boost your cash flow, just a little bit, that's all. You probably can't claim CPI now, given that CPI is flatter than a tack, but you can simply explain there's been cost pressures come through the business, so it's just a small increase and you're very sorry and move on. And it's provided you keep those margins, those increases small enough, as long as you got those margins small enough, you won't impact your trade too much. Now, come back to here, sales volume. Now, obviously, this is actually a trap for young players, okay? It may seem logical that the more you sell, the more cash flow you've got because you've got more money coming in the door. Now, there's a little trap called overtrading. And I've had a few clients in my banking days who have gone bankrupt because they sold too much, which sounds completely bizarre, absolutely counterintuitive. But the problem they got into was that sales require a cash outlay. Okay, now you need to pay for the materials, you've got to get the product in, you've got to pay for the labour to deliver, the labour to manufacture. Whatever business you're in, there is a cost to delivering your product or your service. You've got to fund that. Now, the big one that went under back in the day was a builder, and they simply took on too many projects. And whilst they had the people to complete the contracts, they couldn't pay their suppliers. They were paying out too much to suppliers prior to money coming in for the actual builds. They had one client who paid late, big client, funnily enough, and that put them under. They simply couldn't fund it. They had some of their suppliers issuing letters of demand, and then eventually they got wound up. Not uncommon in the building industry, but it's not uncommon in a lot of industries where you simply trade too hard, too fast, without thinking about how you're going to fund that. So when you look at increasing your sales volume, could I suggest, with respect, that you sit down and actually do up a cash flow? Have a look at, and your accountant can help here, I can help there. There are a number of ASBAS advisors who will sit down with you and work through this with you. So let's sit down and have a look at where you're at now, what your cash flow has been like over the past 12 and 24 months, what actually makes it up, what's the seasonality associated with your cash flow, and then have a look at the next 12 months and have a look at what impact your expansion is going to have on that. Are people going to pay you 60 or 90 days when you're paying your suppliers on 30 or 45? Okay, if they're going to do that, what's the impact on cash flow? How are we going to fund that? And that's the big thing. It's never a question of, no, we're not going to do that. That's not the first answer. The first answer is, the first question is, okay, how are we going to fund that? Because if you can fund it, then do the business. Simples. That's blindingly obvious. Okay, if we can fund it, if we can make that happen, let's do the business. So just sit down and work that. Of course, if you can't fund it, then yeah, maybe we don't do the business. But sit down and have a look at what it is you've got planned, where it is you think you want to get to, and then we'll work out how we're going to make that happen. Now, service, and we went through this just then, okay? Especially with service-based businesses. I've seen 2 law firms that I was looking after from a banking point of view who went under because they simply brought in too much work and they just couldn't get the staff to do it, and it just buried them. And one sold out and the other one merged, I would say, with another firm because they had the resources and they basically took the work. So in terms of increasing revenue, make sure that you can fund it. Okay, it's all about cash flow. Now, Cost of goods sold. Now, even if you're in a service business, you have a cost of goods sold. Okay, these are your direct costs. This is the actual, what it costs you to deliver your product or your service. Now, these can vary depending on your production volume, how much work you've got, particularly if you're, again, manufacturing where you've got a lot of casual labour, or if you're in a warehousing situation, casual labour. People come and go. The cost fluctuates in terms of the production of what you're doing. Okay. Now, these obviously are not your rent, your advertising, your insurance, or your fixed costs, your operating costs. These are simply the raw costs to get your bits and pieces out the door. Now, management of this and basically reduction wherever possible has a direct impact on your bottom line. Okay, if you reduce your cost of goods sold by, say, $10,000, that's another $10,000 profit. Simple as that, because there's no other, it just flows all the way through. So it's very important to look at what your cost of goods sold are and think, okay, what can we do to make a little change? Because a little change is all yours. Simple as that. Can you buy in bulk? Can you get better rates from your suppliers if you pay earlier? What sort of impact does that have? Looking, of course, at the other side being, you've always got to pay all of your creditors, and you've got to fund that early payment. So if you're getting a 2% discount for paying on 30 days, what's that in compared to your actual cost of funds to pay that early? Instead of paying on 45 days, you pay on 30. Okay, the money's actually, for example, using your overdraft for 15 days. What's the cost of that? Simple equation. Give us a call. We can run through all that stuff with you to maximize how this works for you. Okay. Service-based businesses, it's not quite so straightforward, but it's the same principle. Okay, you've got a time component to your production. Is your time being used efficiently? Okay, if you're billing on an hourly rate, are your staff actually working those hours, or could they be doing other things instead? In which case you'd be obviously lifting your volumes without impacting on your cost of goods sold. That would be a very cute trick. So you need to know how many hours are going into things, what actually makes up your production cost. And I even do that myself for my business here. Okay, we look at how many hours do I put into each component of what we do, and where is the most efficient and productive and profitable use of my time. Because if it's not fitting into that box where it's the best use of time, we don't do it. It's as simple as that. It doesn't make sense. So again, have a look at the gross margins in that business over the last 3 years. Have a look at your own gross margins over the last few years and look at what the trends are and think about what makes that up and what can you do to adjust those margins one way or the other. Is there anything you do in the way of your buying power, the way you utilize your time? Could you replace machinery with machinery which is more efficient? And we've just done that recently with a good friend of mine, where we've put in a machine that basically replaces one person and doubles his output. That is a huge win, because the person it replaced is now on a different machine making different bits of gear. It's a brilliant setup. So, overheads, your indirect expenses. Now, this is basically everything else, okay? Now, they tend to be, now again, have a look at your ratios. The equation is there, and have a look at that over time and just see how your cost control, and it has been, and when you've got fluctuations in it, go back to the raw numbers, have a look at what costs actually make up your overheads and compare them year on year on year. Okay, it's a fairly, once you get the first thing set up and you're adding in year after year, it's quite a straightforward process. And just have a look at where the big fluctuations are, because sometimes, and this is not common, but sometimes you'll find there's an expense which has just creeped on you, or there's been a one-off that you really hadn't thought about that much. Those are the things which you need to think about controlling harder. And it could just be that your power costs are creeping up. There's a ton of power providers. Shop around. Your insurance costs are creeping up. Shop around, get brokers. Your finance costs are creeping up. Get a good broker, smash the cost down. There are a lot of options. It will take some time out of your day. I guarantee you that. You will not get this done for free. But it's worth the effort. Now, as I said, the beauty of doing this is it gives you a competitive advantage, because if you've got that extra cash flow in your business, if you've got your costs under control, then you get to do two things. One is you can You can increase your margins a little bit because you can actually, maybe you do with a little less volume at a higher margin, or you can drop your pricing a little bit because you know you've got room to do that and your competitors haven't, and that way you increase your market share, so your cash flow and your profits actually increase. And again, things like accounts receivable days are important here because that can reduce your interest costs, which gives you cash on hand so you can get some purchase discounts. All these things are important. Okay, focus on them. And I know in business, God don't know in business, we've got a million things to do. We've got so many demands on our time. And at the end of the day, the last thing you want to do is look at the numbers. Business, when it's all said and done, business is all about the numbers. It really is. Make the time. Set aside an hour once a week. Get some systems put in place. Your accountant should be able to help you. I can certainly help you. Again, there's a stack of ASBAS advisors who can help you. Put some systems in place to monitor your numbers, and then just spend an hour each week, end of the week, and say, okay, where are we at? Or at the end of the month, take an hour or so out and have a look at how you've travelled, how you went compared to what you wanted to do, and what you're going to do next month. It doesn't seem to be a very productive process when you're doing it, but it is actually critical to making sure you understand where your business is at and what things you can do to improve your profitability and your cash flow, because at the end of the day, cash is king. So have a look at how our friends at the back there have controlled their margins, and we can roll through what's involved there. Now, your business, as I just said, have a look at your current results. Go through how what you've done in the last year, 6 months, 12 months, 3 years, 5 years, and have a look at how your numbers stack up. And if you've only been in business now for a year or so, great. Do it on a monthly basis for the purpose of the exercise. Okay, it will take you a little bit of time, guarantee you, but it will be worth it because you'll see the trends. You'll get a feel for how the cash flow in your business is working and how it's controlled. Put in place some systems to monitor this. Okay, it's not that hard. Most accounting systems these days, Xero, Mile, they'll produce 90% of this information for you. Okay, produce the reports. Take the time not only to read the reports, but to understand what the numbers mean, which is why we record these sessions, and you can refer back to it and go through what we've talked about. Because that way you'll have a deeper understanding of the actual numbers in your business and how the cash flow is working in your business. I know some people who I have subsequently educated who have the opinion that revenue is profit and that's cash flow and it's all theirs. It doesn't work that way. You know it doesn't work that way. It's how much stays behind at the end of the day that counts. Put some systems in place to maximize how much stays behind at the end of the day, because that then gives you more control in your business. It gives you options. You can decide which marketing campaign you want to run rather than having to go for the one that costs you the least, even though the results may be not as good as you want, because that's all you can afford. It gives you options in terms of where you set your pricing, where you can attack your competitors' market because you know they can't move their pricing. So you can simply go under, take their customers, build your business, and then over time, you can move your pricing back up a little bit. There are a whole lot of techniques and strategies and tips that you can put in place around this. It can be as simple as looking at the amount of time it takes to do a job. Is there any way that you can cut the time back a little bit? And there's ways of rewarding staff for doing that, and we can go into that in another webinar. But just have a look at what really makes up your costs. How are you going to control them? What are you doing with the people you owe money to and the people who owe you money? How are you controlling those processes? Do you have policies in place that are clear and explain to everybody involved and that you enforce? Do you have a simple regimented process for dealing with that, where you simply do the same thing every month so people know what to expect? Because in business, that's consistency is key. Now, these are the 7 drivers we went through: your accounts receivable, your accounts payable, your stock control, your pricing, your volume of your sales, and your 2 components of your costs and how you maintain those margins. Have a look at your business, put in place some systems, and away we go. And here, so I said, these are the numbers we went through before. Now, I just want to run through these very quickly for you. Their actual net cash position doesn't seem that high because these guys run a debtor financing facility. So they've actually got effectively an overdraft sitting in the background here, boom, boom, which is funded by their trade debtors. So that is why we focus very hard on maximising their cash flow, because debtor finance is not cheap, certainly not compared to a standard overdraft with property security. I can guarantee you that. And if you look at their stock numbers, their stock here has grown by a bit over 15%. But when we go down a couple of pages, you'll have a look at their actual growth in sales. Go down here, their sales have grown 30%. Okay, so from 1.8 to 2.4, it's about 600K, 30% growth year on year. So you come back up to here and you say, hang on, they've grown turnover 30%, but their stock has only grown around not even 20%. Okay, it's more around that 15% mark. That is efficient, very efficient management of your stock and your work in progress. And that's something we've worked on very hard for the last 5 or 6 years. If I put in 2019 and 2020's figures, you'll see the same trends, because we're focused hard on that. We have systems in place to make sure that we maximise what we're doing on the shop floor. Now, that liquid intangibles, that's just a bit of R&D and stuff, and it's called liquid because they can actually claim it. And then the non-current, again, in the intangibles is really just a goodwill figure, so don't focus on that. That's a non-cash item. Now, have a look there. Their plant and equipment net is quite low. Again, that's because of accelerated depreciation. They have a lot of machinery on the floor, but they've been able to write a lot of it off. And also there's a lot of R&D they do, which creates IP, and they took 2 very big IP depreciation or amortizations in 17 and 18, which kept that number down, and meant that even though they were making some quite decent cash, they didn't have to pay too much in the way of tax. Now, that overdraft's actually their debtor finance, their trade creditors. That's one thing we've actually had to work on very hard, because as they've grown, those trade creditors figures have really come out, and that is money sitting out there that we needed in the business because it's costing a packet on the other side of that line there. Tax office, right? There's always some money owing to the tax office, but again, look at that. They've used their cash to reduce their tax office debt in case they need a favour down the track. The others, I can't remember what's made up of the other liability. Oh, that's right. That's money owed to the directors. Don't worry about that. That's essentially a book item. And again, there's the rest of their equipment and finance facilities. You can see they're paying it down, and there's some more money owed to directors on a long-term basis. So if you look at it, they've actually grown their cash significantly. Like a big change with a small change in turnover, because they're maintaining their margins and they had some very nice write-offs, so they weren't paying too much tax. Now, if anybody has some questions, now is a good time to fire up. Just give me 1 second to reply to this one. And okay. Well, if nobody has any questions, what I will do is we should probably just about wind this one up then, now that we've gone through that. Where are we? Because we've actually got through it in good time. Usually we have a few questions with this, with the people wanting things explained, and that winds it out to the full hour. So for those of you who want to follow up with some more information, we want to talk about systems and how we do things, my name, as you probably already know, is Kelby Williams. You can find me through the Business Station site. I'm one of the advisors that sit on the panel that do general business advice, and I'll cover everything for you from cash flow management through to marketing strategies. I touch on HR, but I do prefer to bring in HR lawyers for that. It's especially in Australia, the industrial relations landscape is quite challenging at times. And just simple problem solving with your business. We're all capable of doing that for you. So get in touch. We'd love to have a chat. and hopefully you've got something out of today's webinar. Thank you.